I plan on acquiring businesses and creating an LLC for each one of them. Should they be under their own holding company separate from the one or active assets?
When we're acquiring businesses, there's two ways to acquire a business. You can either acquire the business, as it's referred to as a stock sale, but that applies to whether it's an LLC or a C corporation, doesn't really matter. The concept is that you're actually acquiring the entity, the business entity. Not a big fan of that, because when you acquire a business entity, you're pulling in and essentially buying all of the known and unknown liabilities of that enterprise. Not a big fan of that. I'm sure can imagine why. I don't like risk. I don't like putting you into potential harm's way. So I'd rather you not do that if it can be avoided. The second approach to business acquisition is assets acquisition, meaning you're purchasing the assets of the business. Inventory, name, intellectual property, customer lists, like all of the stuff that's in the business, but you're not actually buying the entity. That is definitely my preferred path. And when you do acquire that, you would acquire that in the vertical, right? So as most of the people in the community have already learned by going through the community, I talk about the real wealth matrix in terms of verticals, and you can have multiple verticals in each spectrum of assets. Remember, when we're talking about the spectrum of assets, we have personal spectrum, we have portfolio spectrum, passive spectrum, and we have non-passive spectrum. And within those spectrums, you can have multiple verticals if you wanted to. And there's a variety of reasons to potentially do that. In what you're describing, what I would do is on the non-passive side, because it sounds like you're acquiring a business that you would be engaging in, right? You'd be materially participating in, so that would be non-passive. If that's the case, I would have trust first, obviously at the top, holding company, and then operating companies under that particular holding company, but it would all be new. So you use new naming conventions, new ownership on record, things of that nature, so that your name is not on public record. And then one of your operating companies, and the phraseology that my team tends to use is we call those mirror companies, because they are mirroring the thing that's being acquired, and all the stuff of the thing that's being acquired is going to be owned then by that operating company. That operating company is buying it. So then that operating company is the thing that becomes the now new going concern. Right now, I don't know how much you've been investigating. I was just talking with another business owner about this last night. I went to a business networking event down in Miami, and we were talking about the fact that right now there are about 7 million businesses that are publicly listed for sale right now. About 7 million. And only about 1 in 12 of every business that's listed for sale will actually sell this year. That doesn't mean it won't sell eventually, just only 1 in 12 sell in any given year. And the reason for that is multifold. One, most business owners don't know how to actually value their business and structure their business for sale from a marketing perspective, from an ops perspective, etc. Two, many businesses do not have a built-in mechanism for transition. For instance, their children don't necessarily want to go into that particular business, right? Their children have other aspirations and are doing other things. And third, they don't have a built-in mechanism of transition with regard to key employees, right? They haven't not built up key employees to a position where they could actually buy the business from the owner. So that means that the vast majority of those businesses then will not be sold, and they will likely shutter. I'm saying all of this because I think everyone should really take this to heart. I'm very passionate about this. All of this being said, it is truly a buyer's market when it comes to business acquisition. I think this is an untapped aspect of creating real wealth for the vast majority of Americans. Most people don't do it because they think it's complicated, it's hard. It's not easy, but it is simple, which means there are processes that you can follow. Like we teach this all the time inside of our program. We talk about this concept of compound asset acquisition. An asset is anything you control which generates cash flow for you, including the potential of a business, right? Acquiring assets are huge. I know that's a long-winded answer to your question, but I wanted to make sure it's really thorough, right? I want you to understand that the acquisition of the business in this spectrum would be trust, holding company, operating companies. Again, the phraseology that we use, the term of art we use is mirror company, and the mirror company would be the acquirer of the assets of the business that you're purchasing. But I would not suggest you actually purchase the business, meaning the entity itself, because when you do that, you are buying any liabilities that that business has that are known and unknown. The reality is there could have been a harm that has been occurred, but the business owner may not be aware of it right now. They're trying to sell their business, they may not be aware. And the statute of limitations on that harm may still be open. So you don't want to get hit with a lawsuit after you close, because it could be very difficult to get the owner that sold the business to you to be on the hook for that now that you are the new owner of the company. That would be my strong counsel to you. Hopefully that helps give you some guidance.